If you want to retire before you reach Medicare age, that's 65, one of the biggest pitfalls that I see is pre-retirees just don't actually understand how both income, when it comes to premium tax credits, Affordable Care Act plans, and taxable income interact. So the purpose of this video is I'm going to break down for you what it looks like to actually distribute income during this period. I'm going to use a case study, and it's going to be between ages 60 to 65. Now, the numbers don't matter as much as the principles. So the three things you're going to learn are, in retirement, income that you live on, meaning money that you can use for your expenses, is not the same as taxable income, and it's not the same as income when it comes to reporting for premium tax credits on the Affordable Care Act when you're going to the marketplace. The second thing is how to strategically think about capital gains distribution and how that impacts the calculation that I just mentioned. And thirdly, utilizing other tax advantaged accounts so that you can have a good combination of living on the amount of money you want to live on, the expenses that you have, having the right taxable income to meet the goals you have for healthcare funding, and making sure that you may be able to still do Roth conversions in the process. I'm Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner. I love doing these videos. Today's is literally just so that you can understand. It is not for personal financial tax or investment advice, just things that I see as I'm working with clients in my practice, and it's one that I think needs to be addressed. So if you've been watching a few of my other videos and you've seen these massive Roth conversions that I am modeling, this is going to be a little bit more modest, but it's really meant for you to understand how the distribution fits together. So if you're someone who doesn't want to do large conversions and you want to do them along the way, this is how you might want to do that. So I hope you enjoy the video, and now on to the rest. Okay, let's set the ground rules for this case. This case is going to be very practical. I'm going to walk you through what it would look like over a 7-year span. So this is age 60 to age 67 for someone who wants to do Roth conversions, but they don't necessarily want to go higher in the bracket because they're not convinced that they know their taxes are going to be substantially higher later, but they also want to be able to leave some money or have the freedom later in life to use it how they wish. That's what this case is about, because often the Roth conversion analysis ends up being very large, and it's an all-in-one strategy, meaning you either do it or you don't do it. I want to show you how you can efficiently distribute and efficiently convert without having to make a large guess on a high tax bracket to convert up to. So what I'm going to show you is this couple. They are age 60. So I'm going to start writing some things on the board here. They're going to work part-time. So they're going to work each at $22,000, so they make $44,000. And that's going to be their only source of actual earned income during this time. Now, why did I choose $44,000? So for rounding sake, in 2026, if you are under Social Security age, meaning your full retirement age, for most people that's going to be 67, if they make a certain amount over that, they're going to reduce their Social Security benefits. Now, they would only be eligible to take at 62, but in case they ever do want to withdraw early, this is the amount of income that I'm setting them up for, so that if they say they got to 65 and they wanted to withdraw, they're not going to lose Social Security benefits. So just putting that out there as just a general education. So our income sources are $44,000 of income. And let's talk about their portfolio. So they have a $1 million IRA. They have $200K in a Roth. They have $100K in an HSA. They have $750K in a taxable account. So in reality, just over $2 million. They also have $120,000 in cash, of which $50,000 is emergency fund. So I'm just going to write EF. Okay, so why did I lay this out? The reason being, they want to convert some of this IRA, but they're not convinced they should convert it all. And secondly, they want to make sure that their plan dictates what they convert, not the taxes. So they want taxes to help them be efficient along the way, but they're not sold. They're not sold that they want to do full conversions. They want to continue to live the life they live, but they do want to leave some money. They don't think they'll outlive it, so they want to leave some of this to a future generation. That's really kind of what I'm thinking here. Now, this isn't the only reason you could do this, but what I want to show you is two things. One, the amount of money you spend in retirement does not equal your taxes, especially if this is your breakdown of assets that you have saved. That's the first thing I want to show you. And two, I want to show you how these things can interact so that you can get a beneficial premium cost on the ACA marketplace if you are age 60, right? So they have this age 60 to 65 where they have to figure out what are we going to pay for healthcare and what's most efficient. So that's really the driving force behind this case. So let's dive in. So what I want to show you here is how are they going to pull from these different distribution sources to hit a certain number. Now first, I want to show you what we're aiming for on the ACA marketplace. So what I've decided here is that they need to have a modified adjusted gross income of $84,000 or less. Now why do I choose that? The reason is because in 2026 there is a cliff, and it's 400% of the federal poverty line. Okay, so basically what that means is for a couple who's 60 and they're married filing jointly, they are a household of two, so they can only make a certain amount before they lose any subsidy for any healthcare marketplace plans. Now let me just show you what this would actually look like. So what I've done here is I've used South Carolina because I just happen to live in South Carolina, but you could use this for any state. This is a great tool, and it's an independent organization that helps you get information about what you might pay for these premium plans. So what I put is a household of two, $84,000, adults age 60. So what this is showing you here is previously, prior to 2026, there were enhanced premium tax credits where you would pay less percentage of your adjusted gross income for healthcare. Now on the right, it's this column that says without enhanced premium tax credits. This is our current climate. So there's still an opportunity to pay nothing below 400, but you would have to get a bronze plan, which there's one benefit to a bronze plan that didn't exist in 2025, and that's that you can actually have an HSA or a health savings account. So that's a pro. That would allow you to continue to contribute to a plan between ages 60 to 65 if you wanted to. The downside is obviously you're going to have a higher deductible. So the point of this video is not to show you how to choose healthcare plans, it's so you understand the math behind why you pay certain amounts. So in reality, let's just assume that they're going to utilize a silver plan, right? So that's $697 per month. So let's just kind of think about what would that actually be on a yearly basis. So that's a little bit over $8,000, right? So remember, if they chose a bronze plan, that would actually be zero. So let's go back to this, and let's go back to our case. So let's talk through what does that actually mean. So what it means is we have to understand the income sources that make up that 84,000, because that's really an ideal range to be in. And before I leave that, I just want to make it higher so you can see. So what happens if we're off? What happens if we don't know our income sources? What happens if our modified adjusted gross income is 95,000? I'm just going to show this to you. Okay, so we just made a huge difference, right? That was almost a $2,000 a month difference, right? So $697 versus $2,419, that's basically $1,800. That's over $21,000 that we actually have to pay now that we didn't have to pay before. So that's a big mistake. So the reason I want to show this to you is it really matters because these are real dollars, and this could really mess up that couple's plan. So what I want to show you is what counts and what doesn't count for that modified adjusted gross income. Okay, so the first thing is going to be, one, it's going to be non-taxable Social Security. So in this case, they don't have that. So we can cross that off the list. The other thing is going to be that tax exempt bond interest. So think municipal bonds. So I'm just writing tax exempt interest. In this case, their brokerage account is equities, so that doesn't matter. The other thing you need to know is that capital gains count. Okay, I'm going to literally write this in large letters. This is something that I can see people getting tripped up on. Just because you have capital gains and you have the 0% tax bracket on those gains does not mean that they don't count. So underline this, pause the video, go back and hear that again. Capital gains count. So I want you to know that. So what would this couple's income actually look like for the year? So let's assume they take $44,000. That's from their jobs. Okay, so they're actually making 44. That is ordinary income. Of their brokerage account, let's go back to 750K. They're going to take 30,000. That's going to actually be sold to hit their bank account to live off of. But what will flow through to taxes is, let's just assume this is a split of 25% gains and 75% their money. So in that case, this will only actually end up being $7,500. So for the premium tax credit, all we need to worry about is 44 plus 7,500. Okay, so in this case, we're firmly in our in the bracket that we want to be in, right? So is this less than 84K? The answer is yes. Now here's the problem. What if they want to live on more money? So let's try and get them as close to their living expense as their taxable modified adjusted gross income, because what you report for income and what you live on are two different things. So in this case, they're living on 74,000, but what if they want more? So this is what's actually hitting their bank account. That's 44 plus 30. What if they want to live on more? So my idea would be, let's think about those other income sources. Remember, HSA, Roth. Those are still available to us, right? We've got 100,000 here, 200 here. So what if we just took 4,000 from HSA? And again, if you chose Silver Plan, that would just go to meet your need that we decided on, right? So that would go to pay that 6 and some change hundred a month for your healthcare. Or Roth, let's do 8,000. Now, do these appear anywhere on modified adjusted gross income? If the 4,000 is qualified, either it's a reimbursement for previous medical expenses or expenses that you're paying in the current year, the answer is no. Roth is always going to be tax-free as long as you met the qualified distribution rules. So in reality, we just got $86,000 to actually live on. Not bad. Now here's where this gets even better. Say that you say, okay, I'm fine with living on $86,000. I like that. I can do that from age 60 to 67. Great. So we've got a plan. This will continue. We haven't touched, the one account we haven't touched is the $1 million pre-tax. Now again, I'm just calling this an IRA. Now, say that you're not sold. I don't want to convert $1 million of this. I just want to convert half. Okay, great. So if your goal is to convert 500,000, how do we do that? Well, if we're thinking about the math on that, what if we try to do $75,000 for 7 years, right? So I want to show you what that would actually look like. So let's move off the whiteboard now and let me show you this in the tax software. So what would that actually look like? So this is where cash comes in. Remember, they have 120K in cash. This is why it matters to have so many different accounts and to really plan well when you retire or before you retire. After you've retired, it's too late. You need 5 years, 10 years. You need to be thinking about this ahead. So if you have 120 cash, let's say that 50K of this they want for emergencies. Okay, that leaves us $70,000. Another way to say that, or 10K a year for taxes. Okay, why do I say for taxes? Because if I look at this, now follow me here, I'm going to show you inside my software. Before I show you what that Roth conversion looks like, I want to show you what their taxes would look like prior to doing anything. So remember, all we're flowing through to taxes is $44,000 plus $7,500. So we've got $51,500, we have a standard deduction. So this is our taxable income. We're paying next to nothing in taxes. Now you might say, oh man, this is a great opportunity. We can massively convert all the way through these brackets. Well, guess what? You don't need to do that. So remember, you can let your plan dictate it. You can do a smart thing, but you don't have to go all in if you don't think you want to. So in this case, $75,000 of a Roth conversion. So remember, what does a Roth conversion actually mean? It just means in the IRS's eyes, in the government's eyes, you made $75,000 more that year. So what does that look like on taxes? Well, all of a sudden you're at $126,500. That's your adjusted gross. There's your standardized deduction. Your taxable income would be $94,300. Now the only thing, again, there's a trade-off here. I want to be perfectly clear, right? If you do that conversion, then all of a sudden you would have to weigh the pros and cons of how much of this do you want to miss, right? Because now all of a sudden this becomes, right? So we'd have to put 126 in here. So we would have to burn a little bit more of our cash, right? So we would have to weigh the pros and cons of, okay, we just gained a lot of tax-free money, but we also gained $20,000 of living expenses. So there's a couple ways that you could mitigate that. You could either decide to pull more from your brokerage and drain that account earlier, knowing that you'll have tax-free money, or you could adjust how much you work, right? If your part-time work, if you want more income. Again, so there's some ways that you could figure out how to do this, but what I want to show you is that 94.3 also allows you to stay within the 0% tax bracket for your capital gains that you distributed for income. So the trade-off I want you to see is you paid almost $10,000 in taxes. So you increased $20,000 for the year, the $10,000 for taxes. So in this case, another way to think about this is you converted $75,000 and you pretty much had to pay $30,000 on it. Okay, that's a pretty high price. Now again, depending on what your goals are, right? If this isn't going to break your plan, I'm not saying that you can't do this, but you need to think about if you had to increase that premium healthcare plan, this was a pretty big problematic decision. Now, if you wanted to be more modest with this, right, what would it take for you to stay within that range, right? Because we just got knocked out. So if you wanted to do more modest conversions, so $75,000 is what it would take to convert half that IRA. But what if you just said, okay, let's be a little bit more realistic. Why don't we just aim for $250? So we're just going to convert $250 over 7 years. So in this case, we're thinking more like somewhere between, let's just see what 30 would do. Okay, so I'm just showing you, okay, we couldn't do 75, that really knocked us out. What would 30 do? Okay, well 30 is still within that range. So you're going to have to be somewhere between $30,000 and $35,000 of conversion. Plus you do reserve some of your cash. You only had to pay $4,500 in tax. So this is a more modest plan for this particular couple and their mix, right? They don't have to totally give up that $20,000 a year in the premiums for healthcare. They can still maintain a very good standard of living while they're still converting. So if they did $30,000 a year, again in this case, that's $210,000 converted. With growth, it's probably going to end up being somewhere around $230 by the time it stops. So I'm just going to use that as a base. So say you get to 67 and you have $230,000 in a Roth. Because you don't need it for a long time, say it compounds, and say you end up compounding that at a 7.5% rate for 20 years. What's the result? You've almost got closer to $1 million than not, 977,000 roughly. Again, that's not exact. But the point here is there is a way to still get some Roth dollars, but not be all in, because you have to figure out what the trade-offs are. Now, for some people, the 20,000 extra dollars may be worth it, but I would argue that that's a lot to pay for that Roth conversion. As I conclude this video, I just want to say this is not right for everyone, and it's not meant to be personal financial, tax, or investment advice. It's just for education. You may decide to do this, you may not. You may think it's a great idea, you may think it's a terrible idea. I'd love to know what you think. Please comment. I'd love for you to subscribe and continue to follow along. I love doing these videos, so I want to know what you want to see. I did this because I've done some videos where, again, the concept was much larger conversions over time, so I wanted to do something more modest. So I'd love to know what you think. Please like, subscribe, and I will see you on the next video.